Oil continues to rise as the US dollar declines, OPEC announces demand forecast. With the inflation data of the United States and concerns about interest rate hikes, OPEC has released their demand forecast for the current and upcoming years, indicating all to be dismal for the oil market. The result is another price surge for both US crude and global benchmark Brent, even as some traders raise other issues, increased production from Iran and Iraq, while news of production cuts from Saudi Arabia and Russia continues to make waves. WTI futures rose by $1.14, or 1.5%, to $76.89 per barrel. U.S. crude benchmark rose 4% for the week, extending the 4.6% increase from the previous week and the 2.1% increase from the week before that. Brent futures, based in London and ending trading in New York, increased by $1.25, or 1.6%, to $81.36, after reaching a 3-month high at $81.42. Brent oil rose 3.7% for the week following a 4.8% increase from the previous week and a 1.4% increase from the week before that. Craig Erlam, an analyst at online trading platform Oanda, stated that the recovery momentum is largely due to the extension of Saudi's 1 million barrel production cut until the end of August, along with a 500,000 barrel reduction in exports from Russia. Some profit-taking at these levels would not be too surprising and may come sooner if there is no US CPI data. The lowest US inflation growth rate in over 2 years reflected in the Consumer Price Index report for June on Wednesday alleviated many market concerns about the possibility of tightening by the Federal Reserve, pushing the US dollar to its lowest level in 15 months, benefiting oil and other commodities priced in this currency. However, the weaker-than-expected economic performance of China since the beginning of the year remains a concern for those monitoring purchases from the world's top importer. The latest monthly report from OPEC does not provide any clear forecast about China's demand, except stating that continuing improvements in China are expected to boost oil consumption. Meanwhile, customs data from Beijing tells a different story. Exports decreased by 12.4% compared to the same period in June, the highest in 3 years, due to higher global interest rates reducing demand for Chinese goods. John Kilduff, a partner at New York energy hedge fund Again Capital, said, OPEC's demand forecast is highly unbelievable, but the leading OPEC nation, Saudi Arabia, is doubling down on production cuts. Their strategy is to ensure supply doesn't exceed demand. But if they truly believe demand will be so high, should they add more or at least maintain current production? Reuters also observed a similar situation, stating that OPEC is pumping significantly less while claiming that demand will remain firm. OPEC, or the Organization of the Petroleum Exporting Countries headquartered in Vienna, stated that they expect global oil demand to increase by 2.25 million barrels per day in 2024, a 2.2% rise following the 2.44 million barrels per day increase projected for 2023. Reuters noted that OPEC's demand growth forecast for 2024 is double that of the International Energy Agency, another closely watched forecaster, which was published earlier on Thursday. OPEC's forecast for China's demand is not supported. The OPEC report also showed that the group's production increased by 91,000 barrels per day to 28.19 million barrels per day in June, led by Iran and Iraq. Iran is one of the OPEC members exempt from production cuts. OPEC noted that the United States is expected to contribute the most to non-OPEC supply expansion in the coming year, although they see growth in output slowing to 500,000 barrels per day in 2024 from 730,000 barrels per day in 2023. Kilduff said, "None of these forecasts have any support or meaning. China's economic growth is at its lowest, while U.S. oil production remains consistently higher since the worst of the pandemic without signs of slowing down. It's classic OPEC, keeping the market in fear of tight supply while implementing below target production cuts to maximize price impact."